Time now for today's Market Movers from CME Group.
Welcome to Market Movers. I'm Jim Urio, and today we're looking at the non-farm payrolls number on the 10th and a Janet Yellen speech in between. We're looking at using E-mini options to hedge that event risk or create exposure. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Scott, we have seen wild optimism. Can this number or this speech be a slap in the face to that optimism?
I don't believe it can be a slap in the face. Can it slow the roll a little bit? Yes, Jim, but I believe we're seeing a lot of buyers coming to the field here, and so the momentum is going to be something that's hard to stop.
Okay, now before we dive into our trade discussions, I want to point out that with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products, manage risk, or create additional trade opportunities, not as trade recommendations. Prices and movements will vary in the markets. The contract is trading right now at about $23.96 when we price these up. Scott, how do you do it?
So staying with the momentum trade here, Jimmy, and if you want to express yourself bullishly, I'm looking at the week 2 Friday expiration. So that's going to actually expire on non-farm payrolls day. So that specifically the 2400 2420 call spread, which I think is reasonably attractive at 7 ticks or $350. So you risk the $350 outlay to make the potential $650, as I believe the momentum trade continues off of what promises to be a potentially good non-farm payrolls number.
Isn't this rich? You are giving a bullish trade, and I am going to give a trade the opposite direction.
So one of us will be correct.
After 6 months of being a bull. In my mind, it seems like, today being up 33 handles. To buy something, I don't know. At some point in time, there has to be a pullback. We've had approximately 13 days of higher highs. So I'm looking at buying the week 2 Wednesday. Before you jump on me and say it goes off 2 days before non-farm, I'm going to explain in a second. The 2390, 2385 put spread for 1.6 ticks. Okay, this goes off March 8th, Wednesday. Like I said, it risks $80 to make a potential 170. And here's what I believe. I believe that it's possible that everyone gets so optimistic and so bulled up that all of a sudden they see on Wednesday or the day before that they're coming into an event risk with non-farm payroll and have to take some money off the table. So to me, this seems interesting. What do you think?
Well, this is one of those trades where, Jim, you can manage it. We talk about this a lot. You can manage how the action is going to lead into the expiration, because I agree with you. If the momentum builds from here, which seems absolutely crazy but possible, that might be a reason to get a little bit more defensive into the number. But I believe the number is going to be expected to be very good, and therefore that's going to take the market higher.
If it's very bad, lastly, does it matter that much? Are we just going to say that's from an economic ideology that's passed and we have a new one in place? Does this number only matter if it's good, or does it also matter if it's bad?
That excuse, Jim, is only going to last for so much longer. I mean, at some point we're going to have to see good numbers, but this is actually the first full month that represents the Trump presidency, so it will be interesting to see the rhetoric come in if this number is poor.
Well, thank you for joining us in this special edition of Market Movers. I'm Jim Urio, where we're helping to make you a better trader.